The Nasdaq closed lower and underperformed the S&P 500 and the Dow on Monday, with Tesla shares falling on concerns about its spending plans. The Dow gained 0.2%. The S&P was up fractionally, while the Nasdaq shed nearly 0.3%. Tesla shares fell after the electric vehicle maker raised its 2023 capital expenditure forecast to ramp up output. It was one of the biggest drags on the benchmark S&P, along with Microsoft, which was under pressure ahead of its results due out Tuesday. Also on deck this week are reports from Google parent Alphabet, Facebook parent Meta Platforms, and Amazon. Tim Pagliara, chairman and chief investment officer at Cap Wealth, says investors should be less focused on tech earnings per se and more concerned about how much influence big tech wields within Wall Street's indexes.
If you're an investor, that has increased the amount of risk that you have in owning an index because the leadership has narrowed to about 10 companies that make up a big disproportionate part of the S&P 500 and Nasdaq. And so as they go, so does your return. And I think it's more prudent at this point to really focus in and own companies that don't have the higher valuations. Diversification is important, and it's even more important. And an index won't give you the kind of diversification that you need right now.
Also dragging on the S&P 500 was air conditioner maker Carrier, after reports citing unidentified sources said the company was in advanced talks to acquire German industrial manufacturer Viessmann for more than $12 billion, including debt. In the penny stock department, shares in once popular home goods retailer Bed Bath & Beyond tumbled after it declared bankruptcy on Sunday. Retail rivals including Target and Walmart gained ground during Monday's session. And shares of First Republic Bank rose ahead of the regional bank's quarterly report. The stock has sunk 88% this year, triggered by the U.S. banking crisis.